Hey guys, this is the Investment Venturer, and welcome to the Investor Next Door podcast. Today we'll study the business Google, now a part of Alphabet Inc. I should let you guys know that anything said on this podcast should be used for information and entertainment purposes only. This is not investment advice, and I do not recommend diving into any project or trying any strategy without doing your own research first. Alphabet is traded on the NASDAQ under the ticker symbol GOOGL and GOOG. The company was founded in 1988 as Google and restructured to Alphabet in 2015. They have a market cap of over $2 trillion with approximately 180,000 employees. Alphabet is a technology conglomerate. Google is its largest and most profitable division. Alphabet separates its core businesses into Google Services, Google Cloud, Other Bets. Let's dive into each segment. Google Services, Core Business. Google Services generates most of Alphabet's revenue and profit. Key products and platforms: Search, Google Search Engine. Ads, Google Ads, AdSense, AdMob, DV360. YouTube, Android OS, Chrome browser, Google Maps, Google Play Store, Gmail, Drive, Photos, Meet, Docs, etc. Revenue model: Advertising, primary, greater than 75% of Alphabet's total revenue. Search ads via Google Search and partner sites. YouTube ads, video and shorts. Display network, web and app publishers. Google Cloud includes Google Cloud Platform, GCP, infrastructure, AI ML tools, BigQuery, etc. Google Workspace, Gmail, Docs, Sheets, Drive for Enterprise. Target customers: enterprises, developers, governments, AI startups. Revenue model: pay-as-you-go cloud services, enterprise subscriptions, Workspace. Performance: revenue, 2024, approximately $40 billion. Operating margin, recently turned profitable, approximately 5 to 10%. Now third in market share behind AWS and Microsoft Azure. Google Play Store, app sales, subscriptions, 30% commission. Hardware, Pixel phones, Nest devices, small percent of revenue. YouTube Premium/TV, subscription-based recurring revenue. Performance, 2024 to 2025. Revenue, approximately $300 billion, Google Services segment. Operating margin, approximately 30%. Other bets: these are high-risk, long-term innovation projects. Key projects: Waymo, autonomous vehicles, Verily, life sciences/health tech. Wing, drone delivery, Calico, anti-aging biotech. DeepMind, formerly under Other Bets, now part of Google. Revenue profit: minimal revenue, operates at a loss, approximately $5 billion per year. Purpose: moonshot projects that could create future Google-scale business. R&D and AI. Key focus areas: generative AI, Gemini AI platform, chat, code assist, APIs. Search AI, AI overviews and multimodal search. Quantum computing, Google Quantum A. Robotics, natural language and ML, DeepMind innovations. Alphabet is one of the largest AI R&D spenders globally. Key competitive advantages: search dominance, greater than 90% global market share in search. YouTube, 2 billion plus users, massive video ad inventory. Android OS powers approximately 70% of global smartphones. Cloud innovation. AI/ML tools attract developers and enterprises. Data advantage, vast consumer usage data across services. Brand and trust, one of the most valuable and recognized brands globally. Risks and challenges. Regulatory pressure, antitrust lawsuits, US, EU, privacy laws. AI competition, OpenAI, Microsoft, Meta, Amazon. Ad market. Cyclicality, ad revenue is sensitive to economic downturns. Cloud wars, competing with AWS and Azure is capital intensive. Dependence on search and ads. Majority of revenue comes from advertising. Let's talk about why investors like Google. Dominant market position. Search engine leadership. Google search controls over 90% of global market share. YouTube, world's second largest search engine and dominant video platform. Android OS powers approximately 70% of smartphones globally. High margin, scalable business model. Advertising. Most revenue comes from ads via search, YouTube, and display network, extremely profitable and scalable. Cloud growth. Google Cloud is growing fast and now profitable, becoming a key revenue driver. Strong financials. Massive cash reserves, approximately $100 billion plus. High free cash flow generation. Consistently strong margins and return on equity, ROE. Recently initiated share buybacks and dividends, adding investor appeal. Long-term growth potential. AI leadership, deep investments in AI, for example, Gemini, DeepMind, Vertex AI, could power future products and services. Cloud and enterprise, gaining ground in cloud services and enterprise productivity, workspace. Other bets, moonshots like Waymo, autonomous driving, Verily, health tech, offer optional upside. Durable competitive moats. Network effects. Billions of users rely on Google products daily. Data advantage. Collects and utilizes massive amounts of data to improve services. Brand and ecosystem. Google's brand is synonymous with search and web services. Resilient in economic cycles. While advertising is cyclical, Google's diversified revenue base, for example, cloud, YouTube subscriptions, offers increasing stability. Now that we see why investors like Google, let's talk about Google's dividends. Quarterly payout, 21 cents per share. Annualized total, $0.84, giving a modest yield of approximately 0.47%. Payout ratio, approximately 9% of earnings, leaving plenty of cash for reinvestment and growth. Recent ex-dividend date, June 9, 2025. Corresponding payout was on June 16, 2025. Why it matters. New dividend policy. Alphabet only started paying dividends in mid-2024. It's a strategic move to complement its $70 billion buyback program and reward shareholders. Building income appeal. This has increased Alphabet's attractiveness to income-focused investors, and tech peers like Meta jumping on board adds credibility. Very safe payout. With such a low payout ratio and robust cash flow, the dividend is highly sustainable. What investors should watch. Next declaration, a new ex-dividend date hasn't been announced yet. Typically, there's a 3-month cycle. Dividend growth potential. While there's no history of increases yet, Alphabet's strong financials give it flexibility to raise payouts over time. Combined shareholder returns, dividends plus ongoing buybacks suggest a strong total return strategy favored by many institutional investors. Bottom line. Alphabet now offers a stable, modest dividend on top of its dominant growth story and aggressive share buybacks. It's not a high-yield play, but it's a solid, conservative enhancement to its total return profile. Let me know if you'd like to dive into historical payout trends, dividend taxation, or how it compares to peers. While investors generally like Alphabet, there are several key concerns that create hesitation or risk. Regulatory pressure, biggest concern. Antitrust lawsuits. Ongoing US and EU lawsuits over alleged monopolistic behavior in search advertising and Android. Fines. billions in past fines, with potential for more. Breakup risk. Some regulators and politicians want Alphabet broken into separate companies. Advertising dependency. 75 to 80% of Alphabet's revenue still comes from ads, Google Search, YouTube Display. A slowdown in ad spending, e.g. during recessions, hits revenue hard. Growing competition from TikTok, Amazon ads, Meta, and even AI-generated content could dilute market share. Artificial intelligence disruption and execution risk. Although Alphabet is a leader in AI, DeepMind Gemini, it's perceived as slow or cautious compared to OpenAI, Microsoft, and others. Gemini launch faced negative headlines due to bias image issues. If Google search becomes less dominant due to AI chatbots, ad revenue could take a hit. Cloud profitability lagged peers. Google Cloud has recently turned profitable, but it lags AWS, Amazon, and Azure, Microsoft, in both scale and margins. Investors worry it could struggle to maintain growth and margin expansion. Other bets, bleeding money. Projects like Waymo, Verily, and other moonshots under other bets consistently lose billions annually. No clear monetization timeline, and some investors view these as distractions or capital sinks. Capital allocation scrutiny. Alphabet only recently started paying dividends, 2024, despite holding huge cash reserves, approximately $100 billion. Critics argue it hoarded cash rather than returning it to shareholders earlier. Public and employee sentiment. Layoffs and cost-cutting have impacted morale. Public trust is also under scrutiny with issues like content moderation on YouTube, AI hallucinations, and data privacy. Valuation risk. After a strong stock rally, some fear Alphabet may be fully priced or overvalued, especially if growth slows. Earnings growth must justify its $1.8+ trillion market cap. That's all for today, folks. Thank you for listening to my podcast. Be sure to subscribe to the Investor Next Door podcast on